Well, they've done it again. Jerome Powell and the U.S. Federal Reserve have raised interest rates another 75 basis points, or 0.75%. Of course, I'm talking about the U.S. Fed funds rate, the rate that banks charge each other, and not mortgage interest rates. You know by watching this channel that the Fed funds rate does not directly impact mortgage interest rates, but it indirectly impacts mortgage interest rates along with the general economy. In fact, just the mere anticipation of a Fed funds rate hike will facilitate a rise in mortgage interest rates, usually 2 to 3 weeks before a Fed funds rate hike. And we're already seeing that in mortgage interest rates. Now, this rate hike has been anticipated for quite a while. The Federal Reserve is having a dickens of a time trying to get inflation under control, and one of the tools that it has in its tool belt is the manipulation of the Fed funds rate as well as open market operations. I want you to take a look at a few lines from this piece from Deutsche Welle. It's a good idea to look at foreign media and how foreign media report things going on in the US. Deutsche Welle, of course, is a German news agency. The highest level of inflation experienced in the US in over 40 years has prompted the Fed to take aggressive action. Today's rate hike will bring up the benchmark interest rate to a range of 3.75% from the previous level of 2.25% to 2.5%. At successive meetings throughout the year, the leaders of the U.S. Federal Reserve banks have indicated they will continue to pursue more rate hikes, potentially holding the benchmark rate above 4% for an extended time as inflation persists. Federal Reserve Chairman Powell admitted that the rate hikes will also, quote, bring some pain to households and businesses. Of course, you and I and our households are already experiencing pain due to inflation. We keep seeing the prices of things go up, up, and up. The additional pain that Powell is talking about here will come chiefly through a rise in unemployment as people lose their jobs. Make no mistake about it, the Fed wants people to lose their jobs. Say if you're getting value out of this content, go ahead and click that like button and subscribe to the channel for future videos. Thank you. Back to Deutsche Welle. The current inflation has been attributed to several factors, including supply issues amid a post-pandemic boom in consumer spending and the fallout from Russia's war on Ukraine. The Fed has also been criticized for contributing to inflation with loose economic policy, like keeping interest rates too low for too long and for continuing to inject money into the economy. You and I know that excessive spending by the U.S. Congress has been a primary culprit in all this, coupled with the Fed's monetary policy and super low interest rates. The primary motivating factor in keeping interest rates so low for so long was not only to stimulate the economy, which it did, especially in the real estate sector, but also to lower the amount of payments on U.S. federal debt, which has skyrocketed. Notice also this line from Deutsche Welle. Aggressive rate hikes also run the risk of ushering in a recession as overall economic growth is dampened. Folks, that's what we're beginning to see. By watching this channel, you know that I mentioned previously that the Atlanta Federal Reserve has already shown 2 quarters of negative growth in GDP. Just yesterday, the Atlanta Fed released its revised GDP forecast, predicting an anemic 0.3% growth in GDP, which is practically zero. I suspect that this forecast will be revised even lower and that most likely we're going to see 3 quarters of negative economic growth. There are several factors that go into stating officially that there's a recession, not simply declines in GDP. My belief is that we're in a very interesting and unique situation, especially with unemployment being so low, but there are other clear signs that we're either entering into a recession or are already in one. There's something that you're intimately familiar with, and that is the increase in food prices. Now, food prices are not considered a leading indicator of recession, but they're nevertheless very informative. If we take a look at some data provided by the U.S. Bureau of Labor Statistics, specifically prices for food at home, the Bureau's reporting that prices for food at home rose 13.5% for the year ended in August 2022. I want you to notice 2 things. Look at how sharply food prices have increased just in the past year. We've not seen this kind of increase since March of 1979. So food prices have risen dramatically. The second thing I want you to notice is that these gigantic jumps in food prices occur immediately preceding recessions. Look again at the graph. The gray areas are recessions, so going back to 1979, you see that increase in food prices in March 1979 preceded the 1980 recession beginning about January. So there's about a 9-month lag time between ginormous increases in food prices and the official beginning of the 1980 recession. Of course, that recession was followed by the 1982 recession as well, but each and every time we see immediately preceding preceding or during a recession, giant leaps in food prices. Letting the 1980 recession be our guide, let's take a look at this article provided by Wikipedia. The early 1980s recession was a severe economic recession that affected much of the world between approximately the start of 1980 and 1983. It is widely considered to have been the most severe recession since World War II. A key event leading to the recession was the 1979 energy crisis, mostly caused by the Iranian Revolution, which caused a disruption in the global oil supply. The sharp rise in oil prices pushed the already high rates of inflation in several major advanced countries to new double-digit highs, with countries tightening their monetary policies by increasing interest rates in order to control inflation. Sound familiar? Just substitute the 2022 energy crisis brought about in Europe by the Russian-Ukrainian conflict and in the US brought about by state-sponsored ideological warfare against biofuels. Wikipedia continues, like Canada, the early 1980s recession in the US technically consisted of two separate downturns, one commencing January 1980, which yielded to modest growth in July 1980, with a deeper downturn from July 81 to November 1982. One cause was the Federal Reserve's contractionary monetary policy, which sought to rein in the high inflation. Something to think about. What about mortgage interest rates? Here's Joel Kahn, the Mortgage Bankers Association's Associate VP of Economic and Industry Forecasting. Treasury yields continued to climb higher last week in anticipation of the Federal Reserve's September meeting, where it is expected that they will announce, in their effort to show inflation, another sizable short-term rate hike. Mortgage rates followed suit last week, increasing across the board, with the 30-year fixed rate jumping 24 basis points to 6.25%, the highest since October 2008. What will happen with mortgage interest rates going forward? Here's a bit from Holden Lewis at NerdWallet. The aftermath of the Federal Reserve's announcement could be another matter, with up and down swings in mortgage interest rates. But borrowers should brace themselves. Mortgage rates could ratchet upward, like someone climbing a ladder 2 rungs up and 1 rung down. Such a path would be consistent with this year's upward trend for mortgage rates. If you're thinking about buying a home, here are some tips during this crazy economic time. Number 1, you need to have stable employment and be reasonably assured that you're going to maintain your current position and current level of income, or benefit from a better position and perhaps better income. Number 2, you need to have between 3 to 6 months of income saved. This is not your down payment for a home, rather it is your safety net should things become more financially challenging going forward. Number 3, you need to maintain good credit. If you have balances that you can pay off, go ahead and pay them off. Continue making all debt payments on a timely basis. Number 4, don't make expensive purchases that add to your monthly debt burden, especially after you've gotten pre-approved and are under contract for a home. Number 5, shop around for interest rates and for programs that you can take advantage of when purchasing a home. Make every effort to get the best rate and terms you can and lock in that rate as soon as you can. Number 6, in the current economic environment, we're going to see continued volatility in interest rates, and there's a good chance that interest rates are going to move higher. Number 7, that said, if you lock in a rate that's higher than what you want, keep in mind that when our current economic situation cools down in a year or two, you can always refinance. Number 8, if you're looking for a home, keep your eye out for bargains. You may find a property that isn't exactly perfect, but one that you could live with, one that's been on the market for a while and is a good value. Number 9, with the possibility that home values may decline, only buy a home that you plan to own for 7 to 10 years so that any fluctuation in home values that you might experience can be rectified by the time you get ready to sell. And number 10, keep in mind that the Fed funds rate impacts credit card, automobile loan, some new student loans, and home equity lines of credit. With the Federal Reserve increasing rates, you'll see your payments on those accounts go up as well. And here's a video selected just for you by YouTube's algorithm.